Good afternoon. Welcome to today's webinar presented by New Frontier Data in partnership with Cohn Reznick. In today's dynamic cannabis industry, with shifting regulations, evolving consumer demand, and emerging legal markets, investors and business owners need the right tools to evaluate companies today and predict the growth of companies tomorrow. Today, we'll be looking at those tools. My name is Gretchen Gailey, Executive Vice President of Communications and Government Affairs at New Frontier Data, and I'll be your moderator. Just a few quick housekeeping items. First, today's event is being recorded and will be made available to you after the webinar. We will send out an email to view the on-demand webinar as soon as it is available. Second, please enter your questions using the Zoom webinar control panel, which is located on your screen. You can start entering any questions that you may have now, and we will get to as many as we can at the end of the webinar. Now, let's take a look at the agenda for today's event. First, we will introduce our speakers and their respective companies, then jump into our main presentation, and finally end with a Q&A. We want to thank Andrew Lyons and Jim Casimir of Cohn Reznick for being with us here today and for their insights into ways to maximize your company's valuation. Now, before we jump into the meat of our webinar, we'd like to ask you a quick poll question. First off, what question are you hoping to have answered during today's webinar? A, are you looking to acquire information for evaluating your own company? B, information for evaluating an investment? C, ways to save on your taxes? Or D, to quantify risk and opportunities in the space? We'll take a few seconds for you to insert your answer. Thank you for sharing your thoughts. You can continue to enter your answers as we go. We'll reveal the results after we hear from our speakers. Please remember, as we're going through our presentation, to send in your questions. Now to meet our speakers. First, we have John Kaguya, Executive Vice President of Industry Analytics at New Frontier Data. John?
Good afternoon, everyone. It's a delight to be here. My name is John Kaguya, and I'm the EVP of Industry Analytics with New Frontier Data. And for those of you who may not know us, New Frontier is a data and analytics firm focused exclusively on the legal cannabis industry. We view our mission and mandate as presenting a rigorously analyzed, fiercely objective, and deeply insightful perspective, not just on where the cannabis industry is today, but where we see the cannabis industry going in the months and years ahead. As a long-term industry analyst who's been working in sectors ranging from high technology to government and public affairs, I have been truly astonished by both how quickly the cannabis industry is growing and how dramatically it is evolving and how dramatically it has evolved in the past few years. That growth and evolution make it absolutely vital that we have a clear understanding of how businesses should be valued in this space. And so we couldn't be more delighted to be here with the Cohn Reznick team, providing some perspective and insight into the issues and the approaches to valuing businesses in this space.
All right, thank you, John. Next, we have Andrew Lyons, MAI and Principal with Cohn Reznick.
Thank you, Gretchen. So excited to be here along with New Frontier Data. We're very excited to bring you some of our knowledge in the valuation of the cannabis industry, businesses specifically, and then also real estate. I help run a valuation department that includes 40 professionals across the country and in Europe who are dedicated to providing valuations on all types of businesses for all types of reasons. Specifically, my group works on real estate. We do purchase price allocations, valuations for financing and for tax purposes. We've been appraising cannabis real estate in some of the lawful states here coast to coast, and we're really excited to be part of our emerging business line and helping provide services for the cannabis industry.
All right, thank you, Andrew. Next, we have Jim Casimir, Director of Valuation Advisory Services with Cohn Reznick.
Thanks, Gretchen. I am a director in Cohn Reznick's Valuation Advisory Services group. I work with Drew Lyons and our other great team members. My specialty is in the business valuation area of the practice. I've been valuing businesses for about 30 years, have seen many industries over that time, have gone through similar types of growth spurts as we're seeing in the cannabis industry. There's a lot of excitement. Investors are excited about investing in these types of businesses and want to try and get a handle on valuation before they jump in too far. So hopefully we'll be able to bring you some insight with respect to that during today's webinar.
All right, thank you, Jim. Now we're going to dive into our discussion with John leading the way, looking at the trends for business valuations. John.
Thank you very much, Gretchen. So to kick us off, we thought it would be helpful to provide some context on why we're at such a critical point in the growth of the cannabis industry and why it's so vital to understand how to appropriately value businesses in this space. So in that context, we're going to talk about 5 themes that are really driving and shaping the need for accurate business valuations in this sector. So the first is just the overall size of the cannabis industry and the explosive growth that we're seeing in this sector and that we expect to continue to see in this sector. Based on New Frontier's latest models for the US cannabis industry, and we literally just finished these about 2 weeks ago, we forecast that in 2018, the US industry is going to be approximately $12 billion. Growing to nearly $17 billion by 2020 and to $25 billion by 2025. Now, a couple of points worth noting here. First, these are growth forecasts just for retail sales to adult use consumers and medical patients, so sales happening in dispensaries or through delivery services. Second, these are growth projections just for the states where it's currently legal. So it does not include all of the markets which could potentially become legal in the coming years, including the 5 or 6 markets that are in play for 2018 alone. And so in that context, huge growth in demand. These forecasts have been right in line with the actuals as we've done them. So this is probably our 80th iteration, and just underscores the size of the market that is being created in cannabis and the opportunity to build large and successful businesses in this space. A second trend that is really important and is potentially hugely disruptive for this sector is the role that shifting regulations play in creating new market opportunities. Now, we have smaller examples, such as in Pennsylvania, the state initially banned the sale of flower and now has shifted that regulation and flower sales will soon be permitted. Similarly, in Canada, currently you don't have a large market for regulated edible products, but we expect with adult use legalization, all types of products will become legal. But we think one of the most consequential developments in this market will be the FDA, which is currently reviewing a product by GW Pharmaceuticals called Epidiolex, which will be the first whole plant-based extract product that goes through the FDA review and approval process. This product, Epidiolex, will single-handedly create a market for pharmaceutical CBD products, and we forecast that by 2022, the pharmaceutical sector of the market will be in excess of $600 million and account for 1/3 of the total CBD market. Quite literally an emerging sector that is blooming right before our eyes and will present very substantial business opportunities in the coming years. And with all of these developments, both with the huge demand we're seeing on the consumer side, the easing of regulations that create opportunities to build new types of companies, new types of products, we're also seeing a very significant influx of capital to invest in cannabis businesses. Based on data collected by our partners, Viridian Capital Advisors, between 2015 and 2017, Viridian tracked nearly 1,200 deals totaling $5.7 billion in capital investments, both in public and private markets. The bulk of that capital went into cultivation and retail and biotech and pharma, which kind of intuitively makes sense when you think that what the industry has been building and investing in most significantly has been in building operational scale, building cultivation facilities, retail stores, and investing in the research and development to build new cannabis facilities. But when you drill into this a little more, you also see that it's not just that the total amounts going into the industry are very significant, but they're growing as the industry has matured. So just focusing in on cultivation and retail, in 2015, investments in that sector totaled about $135 million, at least that Viridian tracked, and that jumps to $1.7 billion in 2017. Across these top 5 sectors, the average growth in investment between 2015 and 2017 was 454%, which means there's a huge rush of capital into this sector, and investors are hinging those investments on appropriate valuation. So we can't stress enough the importance of getting those business valuations right. And so from the last couple of slides, we've seen how much money has been going into cultivation and retail. And you're starting to really see investments in cultivation scale really on a magnitude that we have never seen before in legal cannabis. Based on some data collected by Growers Network, the 10 largest cultivation facilities which have confirmed facilities that are in development will have a total of 12.5 million square feet of production capacity, and 7 of the top 10 will have confirmed over 1 million square feet of production capacity apiece. While this does raise some concern long-term about overproduction, and indeed we've seen in markets like Oregon the significant negative outcomes of overproduction. In Oregon last year, they produced 3 times more cannabis than was sold. Broadly speaking, one of the key signals here is as the industry is growing, operators are investing in capacity and scale. And with that scale, with these new facilities will come very significant investment in technology and innovation to make those operations run as efficiently as possible. Because as cannabis is commoditized, operators who have achieved economies of scale, highly efficient operations, lowered their production costs as much as possible, will be the ones who will be best positioned for success in the long term. And all of this become influential factors in how those businesses are valued and will be valued in the years ahead. And so we've talked a lot about the cultivation side in particular, but we also want to make sure that we give some thought to the retail side as well, because consumer preferences and consumer purchase behavior is evolving as these legal markets mature. Not only are there a magnitude of order more products available on the market for consumers to purchase, but you're also seeing a shift in which products consumers are buying. We have some data here from Oregon that shows that flower commanded 71% of the market just in November 2016, and that's already fallen to 59% of the market as of February this year. In that time, concentrates and extracts have grown from 18% of the market to 30% of the market. So as you think about where your operation sits in this industry, it's also really important to know whether you are a producer, a processor, or a retailer, how these evolving consumer preferences and behaviors are shaping demand for product, and how that evolving demand for product will impact corporate sales, business sales, as well as business values in the years to come. So just a quick wrap up. We know that adult use legalization is driving significant new market opportunities, and that will certainly be the case in North America for the coming years. Regulatory changes, such as FDA approval of cannabis-derived drugs, are creating entirely new market classes that will create huge industrialization opportunities, but also present new challenges in terms of evaluating untested business or untested products in the market. There's a lot of capital coming into cannabis and looking for a home, which makes paramount the ability for both investors and the business owners to get their valuations dialed in to ensure that investment capital is appropriately allocated. And two of the areas that we're going to be seeing the greatest amount of activity, including cultivation operations, because the industry still has a ways to go to build all of the scale required to meet market demand. And in retail, where evolving consumer preferences are shaping or are creating new opportunities for new types of products and new types of businesses to build those products. So with that, I will turn it over to Andrew Lyons from Cohn Reznick to really dial in on valuation in cannabis.
John, thank you so much. Really amazing data. We're so happy to be working with you guys. It's very helpful in some of the processes that we go through when we're valuing cannabis businesses and also real estate in the cannabis industry. So first, let me tell you a little bit about Cohn Reznick. We are one of the first national accounting firms to dedicate strategic resources to serving the cannabis industry. And our clients range from vertically integrated seed-to-sale operating companies to the investment funds and investors providing some of the capital. Our cannabis industry practice is built upon a foundation of industry and technical subject matter expertise applied to this unique product. And together with our strategic partners, we are uniquely positioned to deliver insights and value-added services throughout a company's life cycle and throughout this market's evolution. The cannabis companies experience unique accounting problems exclusive to this industry, including a shortage of banking services, Internal Revenue Code Section 280E, and being denied services from anti-cannabis vendors. We are well versed in the tax issues facing the cannabis market, including some issues with valuations. So let us kind of level set when we're talking about real estate. We'll start this webinar from the ground up, as it be. So first of all, we have our cultivation facilities. Some are indoor, some are outdoor. We have different kinds of indoor facilities. We have, traditionally, they are warehouses that have been gutted and rebuilt to purpose under specific state laws. We also have greenhouses, which can vary in size and construction materials. And of course, typical agrarian outdoor facilities. In addition to these cultivation facilities, we have processing. So manufacturing of extracted materials, edibles, testing labs, these are all come under the life science sector of real estate. In addition, we have typical distribution centers, which very much align themselves with traditional industrial spaces for the distribution of goods. And obviously, we have dispensaries where a lot of these products end up being sold to the consumer. So what's been happening in the real estate community? Well, a report from a national brokerage firm earlier this year shows that average marijuana retailers bring in over $1,500 per square foot on average, with some of the top stores even up to $8,200 per square foot. And when you compare that with $325 per square foot for all retailers nationally, and better than Apple, which is widely considered the most efficient retailer in the US, you can see where there might be some attraction to investing in a dispensary. But we also see that a ticket to becoming profitable requires some vertical integration. Many of the largest growers in the country process branded products and operate their own dispensaries. And certainly a major concern for anyone in the real estate world of cannabis are the high costs of build out particularly for indoor grow and processing facilities. These are highly specialized. They need to be secure. They require very sophisticated and expensive lighting, water and nutrient distribution, and reverse osmosis systems. There are CO2 infusion systems, dehumidification. You obviously need some heavy-duty power, and often integrating processing and lab and testing areas within a building that also contains some of your cultivation space. So we found when we looked at some of the costs for build-out in applying some of our real estate valuation procedures, the national publications only note build-out costs between $100 and $150 per square foot. But this is very much in contrast to what market participants were actually spending on their build-out space, which really was more of the $200 to $250 per square foot, some even in excess of $300. Major costs for some of this build-out really is responsible for where these things are located. If you have a facility in the Northwest, it's very different from establishing a facility in the Southeast. You've got different climate, and you'll have different facilities and different HVAC needs, which can very much vary the amount that you're spending on your build-out. So who's paying for all this build-out, and how would some of these costs affect lease rates? New leases of built-out space are really difficult to come by in the appraisal world and not very common. But typically, tenants are charged a base rent and then an additional charge based on an amortized present value of landlord-paid TIs or tenant improvements. And depending on the zoning, attitudes of local feelings towards the cannabis industry, and potential licensing hurdles, we can see a pretty significant difference in the base rate for similar industrial facilities per se, and the actual rates that are charged to cannabis industry tenants. Of course, the biggest hurdle continues to be banking and financing. Most deals are still all in cash. And in some areas, brokers are reporting that they won't get involved with cannabis tenants. However, the lucrative potential is really too appealing. And brokers have noted to us that they often require a little bit more disclosure about the businesses before getting involved. And in dense areas, agreements are usually contingent upon public meetings with surrounding landlords and neighborhood commentary. But with indoor facilities, we want to make sure that everyone understands exactly what the risks are. Our clients are telling us, and our investigations show, that growers are really the individuals in a business that are driving some of the design and build out, especially for indoor space. And the reality is that design aspects can change frequently between growers, meaning that if you're an operator or an investor and you have one grower that you trust and he helps you or she helps you design a specific facility, if that grower leaves and another grower comes in, they may want you to reinvigorate the space based on their growing aesthetic. And so, unfortunately, this is just not standard from state to state, largely driven by different laws and legislation, as well as different preferences for materials. So, we understand now that poor design choices can ruin some crop yields and often result in significant obsolescence to built-up facilities, which can overall deflate the value within your structure. We know that HVAC should probably be about $100 to $150 per square foot on its own. We've also seen in this community that using LEDs can drop operating expenses even by much as $100 per pound. So how are appraisers handling real estate valuations right now? Well, what we viewed is that we found other appraisers using very large adjustments to going in capitalization rates, often resulting in rates that are 15 to 20%. At Cohn Reznick, we feel that some of these risks in the market can be identified, measured, and applied with a very rational approach. We understand that some of this adjustment are by appraisers who don't really understand the industry and believe that the federal ban may result in businesses leaving operations and leaving a landlord holding some real estate that they can never use again. But we also know that the experts know of nearly no rates for businesses operating within states lawfully. We should also understand that if the permit is real estate related, that this can help drive value, and also making sure that market rent is being considered based on how much tenants and landlords are contributing towards the build out of facilities. So are there any other high-risk properties out in the marketplace that are similar to the cannabis industry? We believe that a really good comparison can be made between cannabis and indoor facilities and data centers, especially in the early days of the market. Both are very expensive to build and require expensive power upgrades, climate control, heavy-duty security, and furniture, fixture, and equipment investment. And similar to the cannabis market, investors in the early days of the data center market, especially in the early 2000s, weren't sure what the long-term value of build-outs would be, and they were afraid that technology might become obsolete in just a few years. Lease-up was difficult, and there was fear that if the tenant left or the market changed, developers would be left with a massively over-improved warehouse. And financing, similar to the cannabis industry, was difficult to obtain. But there are, of course, some obvious differences. Data center investors aren't facing some of the same concerns about a federal ban and don't need some of the agrarian infrastructure, such as heavy water use. The cannabis market is providing more of a product than a service, although it seems to be a product with a growing need. But as we can see, data center REITs have done extremely well in the marketplace, even though they were initially not valued very high. We see three examples in the United States: CoreSite, Digital Realty Trust, and Equinix, which had fairly low opening prices the year that they opened on the public markets and have shown pretty substantial growth since that date. Right now, as far as cannabis industry is related, all eyes are on innovative industrial properties, which is one of the first publicly traded cannabis REITs here in the United States. And similar to early data center REITs, their model has been to arrange sale-leaseback structures with existing tenants to replace missing avenues of financing for the high improvement costs. Many of the tenants intend to buy back the buildings at market once build-out is complete and the businesses are established. And we believe as more REITs enter the market and the industry matures, financing should become more available, and we'll see some of these cap rates start to compress, maybe as quickly as the data center market. So what is the future? We know that 5 states are considered likely to legalize this year. We know that the trend is towards legalization, and we also believe that when cross-state trade becomes an option, vertically integrated businesses will probably have the best opportunity to expand exponentially. And we know that when you do valuations of real estate in this space, that an appraiser needs to understand that a lack of standardization for facilities will make valuations of cannabis real estate more difficult for the typical appraiser. This really requires in-depth knowledge of materials, business operations, and state-specific legislation to do properly, and Cohn Reznick is very much willing to help you with some of your issues in this particular area. And now I'd like to pass it off to Jim Casimir, who will give us the business valuation perspective.
Thank you, Drew. So as a business appraiser, one of the most common questions I'm asked is, what is the multiple? Typically, the question goes something like this. I have a client, attorney, friend, looking to buy or sell their fill-in-the-blank business, and they want to know what is a reasonable multiple to value the business. Well, if the business happens to be in an established industry that has seen a lot of transactions over the years, there may actually be an industry valuation method or a range of valuation multiples that you can refer to as a starting point. But in many cases, there is not. I don't think I'm going out on a limb to tell you that the cannabis industry is not one of those industries where there's a recognized method or a range of values that you can quickly use to put a value on a business. For one thing, we must first define what is meant by a cannabis business. Is it a plant-touching business or a non-plant-touching business? And then within each of those categories, what segment of the industry do they fall in? In the plant-touching category, this is defined by the type of license they hold. The licensing requirements are different for every state and local jurisdiction. So what do we do in these situations? Well, we fall back on generally accepted valuation methods that have been used to value similar kinds of businesses over the years. There are typically 3 valuation methods that are used to value companies: an asset-based approach, income-based approach, and a market-based approach. The asset-based approach will usually only apply in certain specific situations, such as when the company is in the very earliest of stages of development, pre-revenue, and has not obtained any capital outside of from family and friends. More common are the income and market approaches. Under the income approach, value can be determined using a capitalization of earnings or a discounted cash flows method. The capitalization of earnings method, while a bit easier, is only appropriate to use when a company has achieved a stabilized level of operations because it relies on historical or next year's earnings as a benchmark for how the company is expected to perform in the future. I've yet to value a cannabis company that has achieved a stabilized level of operation. So that leaves the discounted cash flows method, which utilizes forecasted financial results and then discounts those future cash flows to a present value as of the valuation date. That forecast period should be long enough to get the business to a stabilized level of operations, or as close as possible, at which point a terminal value can be established based on that level of operations. And at Cohn Reznick, we often work with clients to consult with them and helping them prepare these types of financial forecasts so that they make sense. Now, under the market approach, we can look to publicly traded companies in order to get an indication of how companies are valued, or we can look at transactions in the marketplace involving controlling interests in businesses that have changed hands. Also, we could look at transaction involving the subject company's own stock if there have been any recent arm's length transactions. So in the case of publicly traded companies, the most common way to value this are to calculate certain pricing multiples that we can obtain from these companies' results and compare the company's total invested capital to certain metrics such as revenues or EBITDA, earnings before interest, taxes, depreciation, and amortization. These are the most common multiples that are used. If you look over the last few years, though, we can see for publicly traded cannabis companies, they have some eye-popping multiples. It's not uncommon to see multiples for plant-touching companies exceeding 50 to 60 times revenues, and even higher at the end of 2017. Most of these companies were reporting losses from operations, so EBITDA multiples are negative and are of little use in serving as a valuation benchmark. Even the non-plant touching companies are reporting multiples at 8 to 10 times revenues or even higher, and most of these companies are not profitable either. So looking at these market-based multiples, should we conclude that cannabis companies are all overvalued? Well, in order to answer that question, we must look beyond the company's current revenues and earnings. Because growth rates are so high in the first few years of a state opening their markets to medical or recreational cannabis, investors' expectations are also very high. It's not until a market and the companies operating within that market reach a more stable level of growth that an investor can expect a multiple based on a current year results or next year results to appear reasonable. An example, let's take a look at a Canadian company that's been in the news lately, both for the acquisitions it's been making, as well as companies that have been investing in it. Canopy Growth was the first cannabis company in North America to be publicly traded back in 2014. The company's strategy is to focus on developing and scaling to be the world's largest multi-platform creator of brand offerings in multiple formats for medical cannabis markets in Canada and abroad, and also for regulated recreational markets when they become federally legalized. Just in November of last year, an affiliate of Constellation Brands, a major player in the beer, wine, and spirits industry, invested roughly $190 million to acquire just a little bit less than a 10% interest in Canopy. Canopy is using these funds, as well as a subsequent capital raise in February of this year, to expand its capacity to over 5 million square feet of greenhouse and indoor facilities. It is positioning itself for the launch of Canada's regulated recreational cannabis market expected to occur in July of this year. Now, as of the end of 2017, Canopy reported revenues of approximately $55 million US. And as of the end of April, it traded at enterprise value to revenues multiple of 83 times. And looking forward to the estimated year end of March 31st, 2018, the multiple dropped to 66 times. Now, these multiples seem outrageously high. They start to become a little bit more relevant as you look to future years. In 2019, that price to revenue multiple drops to 16.5 times. By 2020, 5.8 times. And going all the way out to 2022, it's down to 2.1 times EBITDA. Now, Canopy is projected to report revenues of $2.5 billion by 2022, to put that into perspective. So you can see, if you're trying to use multiples to determine whether a company is overvalued or to value your own business, unless your company has a similar growth pattern to Canopy, growing from 55 million to 2.5 billion over a 5-year period, using a current year multiple of 83 or even 66 times next year's revenue, probably not going to work very well. So there have been other companies and other industries that have experienced similar valuation patterns. There have been. Let's take a quick look at a company that most people are familiar with, which is Tesla. Tesla first went public back in 2010. Its year-over-year revenue growth has never been less than 32% since it went public. It first achieved positive EBITDA in 2013. Its current enterprise value to EBITDA multiple is 44 times. Again, eye-popping. Going out a couple of years to 2019, the multiple drops to 17.8. 12.2 by 2020 and 6.2 by 2022. Still, the company is yet to report positive net income. It has relied upon multiple rounds of capital raises to build its infrastructure and distribution network, and it still may require another round later this year. Once again, these are eye-popping multiples, but they're supported by a very specific business plan and projections that will not apply to most companies we are trying to value. I've also read that when the California Cannabis Control Board was modeling growth in that state, for purposes of estimating potential tax revenues, they projected that the industry would grow at about the same 28% compound rate as the rollout of the internet broadband access in the 1990s. So you can see people are thinking about how other industries have grown and how that has affected value in those industries. When we meet with clients at Cohn Reznick, we're not looking at these multiples as a starting point in our valuation process. We're looking at typical rates of return that are required by companies, different size companies in different industries. And we look at historically what those rates of return are. So for large publicly traded companies, we see that investors typically require rates of return in the 8 to 10% range. When you get into the smallest of the publicly traded companies, that return increases to 14 to 18%. Now, depending on the specific industry you're in, the rate of return can go up or it can go down based on the risks of that particular industry. And again, looking at any specific company, they may have individual specific company risks that will cause that to go up, such as not having access to banking services, not having access to future traditional funding sources, being subject to onerous federal tax regulations, being restricted on the type of marketing or advertising they can do, etc. Also, the company's stage of development is a very important factor. As evidenced by looking at the rates of return in this table for venture capital investments, we can see that even later stage venture capital investments are going to require somewhere in the neighborhood of 28 to 30% rates of return, and the various early stage companies 35 to 45%. So a plant touching company in the cannabis industry is typically faced with all of the same risks and challenges seen in other types of early stage companies. Therefore, in assessing what a reasonable discount rate would be to discount their projected earnings, venture capital type rates are often used as a starting point in making that assessment. But as a company gets further down the road in the execution of its business plan and can demonstrate the ability to hit benchmarks and milestones, it will be rewarded with lower required rates of return. And after all, a valuation multiple is merely the inverse of a cap rate. A cap rate is the byproduct of the discount rates that we're seeing in this table, less a long-term growth rate. So you can see that in situations where a company warrants a very high discount rate because of industry-specific risks, company risks, and its stage of development, but that it's offset by very, very high rates of growth rates projected for that industry. There are a lot of factors at work that are influencing those valuation multiples. It also means that the multiples in and of themselves are a little of use in trying to make comparisons between companies in different segments of the cannabis industry, operating in different markets, and in different stages of development. So to kind of summarize what we've talked about, cannabis industry is growing rapidly, but not necessarily equally across all markets and industry segments. With a few exceptions, public cannabis companies still have little revenue and are not profitable. The reported pricing multiples for these companies are widely dispersed and in most cases are not meaningful. M&A transactions involving companies in different segments across different states and different stages of development are not comparable. So it's important that if you're trying to use those types of transactions, that you are able to accumulate ones that are within the same jurisdiction, in the same stage of development, and in the same type of industry segment. In almost all cases, investment in cannabis companies has been driven by future expectations of the company and by the overall industry growth expectations themselves. So looking at current multiples is not the greatest way to determine whether a company is overvalued. Rather, a well thought out discounted cash flow analysis is generally the better way to go in attempting to capture all of these different elements within a financial projection geared to a specific company's business plan.
All right, thank you so much, Jim, Andrew, and John. We're now going to head into the Q&A portion of our webinar. Please remember that you can send in questions at any time using your Zoom webinar control panel. Now, before we begin, and this will give you a few moments to actually start putting in some questions, we're going to look at the results of our poll question. Our question was, what are you hoping to have answered today during the webinar? And it appears 26% of you say you're looking for information about valuating an investment, followed by, well, tied up with acquiring information for your own company, and another to save money on your taxes. So, all right, thank you so much. Hey, if you have a tax question that pops up, happy to take it. While we're at it, we're going to ask you one more question, which is for our own edification for future topics. Would you be interested in learning more about A, investment opportunities, B, tax and accounting tips, C, operational efficiency, D, research and regulatory matters? Please take a few moments, fill that out. It'll help us to better see review for future webinars. And also as a thank you to our audience for joining us today. And as an added bonus for participating, we are providing 15% off to all of New Frontier Data's reports and services. Just use the code CANATAX15 on our website, www.newfrontierdata.com. And we will go to our first question, which I'm going to throw out to Andrew. I think this would go to Andrew, but perhaps Jim can jump in. Does having a strong compliance platform help with a company's valuation? Don't jump too fast.
Absolutely. And I think, and Jim, feel free to jump in on this. I think when you're talking about compliance, you're talking about the speed and efficiency through which you can get through a lot of these hurdles.
Yeah, and compliance, is when we start talking about company-specific risk factors, this is one of those factors. So it does not take, a misstep in not complying with a regulation within your jurisdiction to set back a company's business plan quite significantly.
I think what we're finding is because the industry is still so nascent, and there are so many things that municipalities, counties, and states just still don't understand, that you have a lot of frontiers who are really going through and paving and blazing the trail for everybody coming behind them. That's not unique to the cannabis industry. I think that happens in a lot of new and emerging industries. We've certainly seen it at Cohn Reznick in solar and in renewable energy, and there really is no difference here, where you have people who've got to understand what all the risks and compliance issues are, and help pave the way for others behind them.
And those compliance type issues should also be factored into projections when the company is preparing their financial projections. They have to factor in that these compliance does not come without a cost. So those costs need to be planned for and factored into your financial projections.
Okay, next question is going to the Cohn Reznick team. Not much mention of retail valuations. How do these look in tightly regulated states like Pennsylvania or Maryland?
Again, retail valuations in general are all over the board. Unfortunately, this is like the question where people ask what the multiple is. It just depends. Depends on the stage of development you're in, whether you're opening your first dispensary, whether you have already operated 3 dispensaries and are looking to expand, so you're in an expansion mode. The risk is different for those 2 circumstances. The financial projections are different for those circumstances. I think the retail end tends to be a little bit easier sort of to comprehend and to value, because it's a little bit easier to project retail, because we're used to seeing retail valuations in a lot of different industries and how those have evolved. Unfortunately, there's not one answer that I can give you. The evolving markets that have just started are going to have the highest rates of return and the highest risk. The valuations are going to be a little bit lower. However, they're also going to have the greatest potential.
Okay.
Do you see generally speaking, higher valuations in markets with limited licenses than in markets like Washington or Colorado with unlimited licenses?
Absolutely. Where there's significant barriers to entry and you're already holding on to those very significant entitlements, you're going to see significant value associated with them. For example, Maine, they have 8 medical licenses and 4 of them are owned by the same company. So that gives them a position within, all the consumerism that's in the state, and positioned really strongly and well. So those intangibles and that licensure and permitting certainly is going to add to, the overall business valuation.
Right. A lot of people only focus on the growth aspect, but what they don't keep in mind is with high growth, there's high competition, right? Everybody wants to get into their market if they have the ability to get into the market. Where licenses are restricted and those high barriers exist, those companies are protected for the time being.
And unfortunately, it's very state to state specific. You have some states where, the operational permit runs with the business, and you have others where it really truly runs with the real estate. And it's really important that you understand what those variances are, and understanding that the valuation may be different for, a similarly sized company with similar operations in one state can be very different, even if it's the same size and scope, but in a different state.
Okay, this question I'm going to put out there to John, and I'm hoping he can answer this. We are entering the space with an online retail company, 100% American glass pipes and rigs. What do you see as the future for that space, given competition from Chinese importers and eventually Amazon?
So the 2 ways to think about the non-plant touching side of the space, and Glassworks are a great example of that. So the barriers to entry for a non-plant touching business like a glass manufacturer are lower than they are for a business that touches the space, because you essentially don't need to be licensed in order to get a permit for those for your operations. So there's a couple of factors to take into consideration. Broadly speaking, as demand for legal cannabis has grown, so too has demand for high quality glass, and we've certainly seen that glass manufacturers or other ingestible product device manufacturers have seen their fortunes rise in tandem to the growth of the legal industry. Concerns about South Asian and Chinese competition specifically is very real, and it comes in two regards. One is from white labeled products or devices that are being manufactured in China and sold by companies in the US, which is one aspect. And then the second, which is particularly concerning for cannabis companies, is where counterfeit devices which have been manufactured in China are being sold under a branded name in the US. So protecting your IP is going to be really, really critical if you can, because we've already seen a couple of very significant instances of counterfeit products being sold, counterfeit glassworks being sold in the US. But it is a robust market opportunity. It is certainly going to be a competitive environment. But given the continued expansion that we expect to see in this market, we expect that at least for the near term, this will be a tide that lifts all ships.
All right, thank you, John. The crowds are clamoring. They want to hear about 280E. And luckily, Michael Harlow from Cohn Reznick has popped in. Michael, can you give us some quick thoughts on 280E and what companies should be looking at?
Sure, I'll try to keep it relatively concise because the 280E is a pretty popular topic of conversation on the webinars we've done in the past, and you can look back on some of the other articles that we've written in conjunction with New Frontier to cover some of the basics. Basically, 280E is a code section dating back to the mid-1980s that prohibits you from deducting anything except for cost of goods sold related to a plant-touching cannabis business or any Schedule I narcotic business. When looking at trying to minimize 280E, what we're really trying to do is maximize what can be argued as cost of goods sold. And then when we start running into limitations there, being very strategic about how you segregate out your various business components. So if you have a license for a plant-touching business and you also have ancillary business operations and non-plant touching businesses, we want to segregate those so that our 280E costs are not tainted with our ancillary business. So that means segregating your real estate investment entities, your leasing entity that may purchase and lease back any fixed assets used by the plant touching business, your management company, marketing company, all those need to be separate. I believe in the past, people were of the opinion that once they got a license in a regulated state, they had to acquire the real estate and do everything within that name of the business that held that license. And that's not generally the case. The license holder is just the operating business. It's not necessarily the real estate investor. The other thing that segregating your business operations or your business line does is open you up to different investor pools because there may be investors out there that do not want to directly invest in the plant touching business, but would be very interested in investing in a leasing company or a real estate company. It gives them just that one level of removal that makes them feel a little more comfortable. So the number one thing that we advise clients to do when looking at 280E is to be strategic about how they structure the business from the get-go. Because once you've gotten past that part, it may be a little bit too late. The other thing that we think people need to keep in mind is that even though, as recently as 2 or 3 months ago, or at the end of 2017, when major tax legislation was passed, without a 280E fix, we all assumed that 280E was going to be the law of the land for the foreseeable future because it appeared very unlikely that there would be a standalone 280E fix passed. In the past couple weeks alone, my thinking on that has changed pretty dramatically. I mean, you've seen very prominent Republican politicians come out joining boards of directors for cannabis plant touching businesses. You've seen the Democrats respond by rolling out their own legalization initiatives. All of a sudden, being pro-cannabis seems to be the most popular thing in the country, and I would have never guessed that 2 or 3 months ago. So when we're bending over backwards to create structures that are as efficient as possible, considering 280E, we also want to be aware that 280E may not be the law of the land forever, and we don't want to do something that's going to shoot ourselves in the foot a year or 2 years from now when trying to minimize 280E. So it's a complicated issue, but I don't want to take up too much time today to talk about that.
All right, thank you, Michael. Question for Cohn Reznick team. Do you see investors bifurcating the market between adult use and medical use operators? And if yes, do you see a preference emerging?
That's a good question. I mean, certainly states that were traditionally medical now have a rec license. You've seen a pretty big hit to the medical part of that industry. I think where you're seeing medical still be relevant is in the dosage limits and requirements set by certain states. So, Oregon, for example, I can't remember exactly what the number is. John, maybe you know offhand, but if you want a really strong medical size dose, then you still need your medical card, even though adult rec, you can get in and have fun with. So I think that's probably where the bifurcation will still exist, where there's still an opportunity for medical, to be specific. I think the other end of that is in the extraction and edible arena, where we still don't know all of how the 400 different cannabinoids can be used effectively and targeting, very specific maladies in the human body. And so till further testing or until the FDA kind of reverses course, there's probably an opportunity in that environment. But I know, Jim, I don't know how you feel about that.
No, I think I agree exactly. It makes a lot of sense that there's still bifurcation for a period of time because there's unique needs and requirements to meet those needs that are best handled by having specific regulations and a specific market for medical.
Yeah, I think instead of bifurcation being the relevant topic, consolidation is probably the bigger topic right now.
Right.
Yeah.
I got one last question. I'm going to put it out here to Jim. How do appraisers determine the cap rate for a cannabis business? Isn't there a lot of subjectivity involved?
There is a little bit of subjectivity involved. Many people say that valuation is more an art than a science. But as Drew mentioned in talking about real estate appraisals, how there was a sort of a range that people were using, and Cohn Reznick was able to develop some specific factors that would help to narrow down that range. We try to do the same thing on the business valuation side. It's a build-up process. So you're looking at what investors require in other types of businesses or similar industries, maybe the wine and spirits industry, the pharmaceutical industry, depending on the type of cannabis business that you're trying to value. And then you're just trying to build in what the additional risks are of that specific company in its market that an investor would require for additional return. So we try to start with the most specific things that we can target and identify rates of return, but there's always going to be some subjectivity in trying to tack on these additional risk factors that are just not visible when looking at other industries.
There's no doubt that what Jim and I do is an opinion. It's an opinion of value. The difference between a good appraiser and a bad appraiser is that the good appraiser is able to pull a lot of data to substantiate that opinion, as opposed from it just being from their experience. And that's what we would hope would be one of the big reasons why people would want to come and do work with Cohn Reznick and valuators, great valuators like Jim Casimir and some of the people that we have on our team.
All right. Thank you so much to all of our panelists, and thank you for your questions today. Once again, as an added bonus for participating in today's webinar, we are providing 15% off of all of New Frontier Data's reports and services. Just use the code CANATAX15 on our website, www.newfrontierdata.com. And if you would like more information about New Frontier Data or Cohn Reznick, please reach out to us. And as mentioned before, a recording of this webinar will be sent out later this week. Have a great day.